Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to help boost your trading potential. Coming up, with U.S. markets trading near record highs, investors again are weighing fresh pressure on the tech and semiconductor stocks. This is all ahead of Wednesday's FOMC minutes. And of course, next week, we kick off another round of earnings season. Plus, is it clear skies for United Airlines, or is it time to fasten your seatbelts? Our trading debaters, they're here. They want to explore the bull and bear case for United Airlines. They're going to take a look at the stock, the option strategies traders can use to position for either outcome. And snack and beverage giant PepsiCo, it's reporting later this week. We're going to tell you what Wall Street will be listening for and what it could mean for the consumer sector. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour of the trading day. Let's check in on the markets. We'll start with the S&P 500. We got volatility again in the chip trade. Yesterday, it was the chip makers that were lifting the S&P 500. Today, it's weighing on it. Perhaps we need to look overseas for today's catalyst. Memory chip maker Samsung had a strong quarter, but concerns about big spending. And this is the overhang for the sector. Yes, AI has been a boom in many ways, but a lot of money is being spent, and it gets investors nervous from time to time. Seems to be one of those times today. Let's jump into the heat map and see what effect that is having on Wall Street. Right now, as we look at Micron, AMD, Broadcom, we can start to see those chip makers under pressure as well. And Apple and some of the other names. A real mixed bag if you get out of that camp, Microsoft, Google, a little bit to the upside, but we are feeling that pressure from the chip names. Now let's get to our stock of the hour. It is United Airlines. The carrier's strategic shift toward a more premium flying experience appears to be taking flight. Revenue rose more than 10% in the first quarter, and United also trimmed some lower profit flying to focus on its margins. But rising fuel costs have pressured the outlook, and investors are watching to see if higher fares will eventually weigh on that demand. Travel, after all, it's a cyclical business. For the bull and bear perspective on United Airlines, let's head to the desk now. We're joined by Jason Natick and Matt Dempshinson from our direct investing educational team. Gentlemen, welcome to the show.
Thank you, sir.
Welcome back, Matt, from last week. Welcome back after you. So we have a rotating cast that keeps things fresh and exciting. Before we get in, and I don't think I've ever seen. Have you ever guys debated each other before?
We have not.
Have we had this dynamic?
Yeah.
Ooh, a fresh dynamic for the show before we get going with that debate. A quick note to our viewers that the securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold, or recommendations. Now, the stock of the hour is United Airlines. We'll get our time on the clock. I've got my bell this week. I don't make the sound effects on myself. We won't say why I didn't have the bell. You know who you are. 2.5 minutes. I'm in trouble. That's not a good way to start the show with your boss. You got 2.5 minutes each on the clock to make your case. Then we'll get some time to count it. We flipped the coin last week. Matt, you've got the bull case because you're filling in for Heron today. So kick things off for us.
All right, perfect. Thanks, Greg. You mentioned it kind of at the top. Net income almost double in Q1 year over year. Fuel expenses, $340 million. So even with those fuel expenses, year over year, almost doubling your first quarter net income. Pretty big moves, as you mentioned, attributed mostly to like the cutting of those low-cost routes that weren't actually providing a lot to their bottom line, and growing their premium sector. So 14% growth in premium cabins. So joining that kind of like area where they don't have a lot of competition in terms of the loyalty revenue they're bringing in, 13% a boost in that one as well. Mentioned oil prices. Even though oil is down again, they are able to consume. They don't hedge their oil consumption for fuel. So now that it's summertime, hot traveling, people are moving around. This is pretty much the top of the year for traveling. Spending that money on fuel now while it's cheaper at $70-ish is perfect, because that way they can get ahead of the game. And looking at the analyst kind of prediction, looking at all the analysts came out in the last 3 or 4 weeks, and huge increases. So Citigroup, TD Cowen, Goldman, Bank of America, and Morgan Stanley all increased their guidance. Ranges now from $150 to $182. So definitely a premium for what you're seeing at right now. If we jump into the charts, take a look at this daily chart here. We'll see that it's in an uptrend. So we were in a previous resistance area. here in this red area here, the resistance zone. Lots of chopping back and forth, lots of volume. According to the volume profile, this is one of the biggest areas here, from $88 up to around 112, 116. The uptrend has recently broken through that. We met a lot of resistance at 138, but pulling back a little bit, which is natural. So we're still well within the uptrend channel. Looking at the unbalanced volume, which kind of takes a look at the volume on green days versus red days. That's trending upwards. So the green days are outweighing the red days in terms of like the volume that's being, moving in. You can kind of see the red days here, another visual of it on the average. They're well below this yellow line here. So once we break that 138, 139 mark, clear skies, smooth sailing, whatever analogy you want to use. I think here we're primed for an upside move further to follow this trend line, and we'll see what happens next.
Look at that, timed himself out perfectly. There's the bull case. Jay, what could a bear say about United Airlines?
The bear has got lots to say. You mentioned it off the top. The airlines are cyclical, and that's certainly the case. That the market is pricing UAL as the good times are going to keep on soaring, and that just might not be the case. Travel demand normalizing, costs are stubbornly high, and even a small crack in consumer spending could really wreak havoc on profits. And UAL is priced near perfection, and there's some downside risk that might just be underestimated. So let's dig in. One, taking a look at industry-wide, the International Air Transport Association has drastically cut profit expectations for the industry by 45%, down from 41 billion to 23 billion. So that's a big amount. And guess what? The cause of the downgrades are out of airlines' control. We're talking fuel prices, and we're talking geopolitical disruptions. So these are big headwinds for the industry and UAL particularly. That fuel cost, that's a big one that's going to weigh on things. Fuel is their largest variable expense, and this is a big reason why they cut their EPS guidance for 2026 by 33%, down from $13 to $9 per share. That's at the midpoint. So management is only expecting to recover about 40 to 50% of the fuel costs in Q2, meaning there's going to be continuous margin pressures as we look forward. And then that valuation is leaving very little room for improvement. As I said, priced to near perfection. They've lowered their guidance, but the market just keeps pushing up the stock. So investors are, assuming fuels are going to normalize, but what if it doesn't in the very near future? You've talked about analysts, but the fair market value that Morningstar put out has it only listed at $95, so well in excess of that already. So if business softens, if consumer trends weaken, once again, if fuels continue to stay where it's at, there could be cracks in what we're seeing in this uptrend. But let's get ourselves into the chart. So as we can see, the stock has been kind of the normal range. It's been kind of bouncing between kind of a $116 and $90 range, with kind of around that 106 level as a bit of an inflection point, kind of being as support and resistance. So a very kind of predictable chart. Until very recently, we've just now kind of broken out into this kind of really upward channel. But this is some pretty steep kind of bullish move that's been on the chart, but they're starting to see some cracks that we might be heading towards the bottom of the channel, maybe even breaking below it. One of them is seeing is it's resisted breaking top, so it's held the top of the channel, showing weakness at those elevated levels. But most recently, at the top, we can see there's a pretty significant sized, what we call bearish engulfing candle, where it's the largest red candle is engulfing the full body of the green candle. It's a telltale reversal sign that is going to be kind of moving the stock down. After a couple doji candles, which are typically indecisive movements, this is showing that there's some definite bullishness, or bearishness rather, in the stock price.
All right, neither side backing down. That's what we like in a good debate. Now you got 3 minutes to counter each other. You were able, Matt, to hear what Jay had to say. Go at him.
Yeah, so in terms of the chart, I know you mentioned the resistance level there at the 130, 139 level on the chart. Pullbacks are natural. You look at the volume in relation to those down bars, and it's below average. So yeah, there's money being pulled out of the stock, but it's not institutional money. It's not the big spenders. So the analysts, with those upgrades, they're staying. Hey, we're in this. We're looking to go. So the volume that you see, these spikes and green spikes here on these big days. You'll have institutional inflows coming in. The public isn't really putting a dent in the stock as much. Volume is low, so when this does kind of settle and rebound after this trend channel kind of fluctuates, I think we're going to see the volume step in again and keep going.
If we're thinking about spending money, one of the things that airlines do is a very cash-intensive business, and they're spending money. And so outside of fuel, the next biggest cost is labor from UAL. Sure, they may have just negotiated a deal with their flight attendants. It took years, and it was a prickly negotiation, but they didn't get out of that scot-free. On average, 31% pay increase for the flight attendants, and a $741 million in back pay that they owed to that union. And that's only one of their major unions. There's still contentious negotiations going on with their mechanics and their ground workers. Even the union coming out and saying that they've not had raises for years, and there's potential for work stoppages, potential for other labor strife. So that's an unknown that can be weighed on this outside of all the things that we've mentioned. So it's something they really need to be concerned about. And if we want to think about costs, there's something that airlines are judging: cost per available seat mile. Excluding fuel, that increased by 5.9% last year, in Q1, up to $13.95. So that's showing industry costs are remaining elevated even before and counting all those increases that we've seen in fuel. So these are big like nominal headwinds that United's facing.
Yeah, I mean, and that's part of the reason why they are trying to change their cost table. So obviously fuel and labor is a big one, but they're reducing the airline routes that don't bring in a bunch of money. So all these like low budget routes are being cut. As was mentioned, they kind of are pivoting towards these kind of premium.
The business traveler, the wealthy.
Premium business. They're trying to get the wealthy. So there's a little bit less elasticity for demand for those kind of seats. Those people aren't going to be shooken by a small little interrupt in the economy. Those are the people who will have the money and consistently have the money to spend on it. So
I'd like to be one of those people.
what do we all, right?
Whatever, I'll just pay it.
Well, yeah. So those margins are going to be there, and they just pass on any kind of increases in price to the user.
If you took in a 14% increase in premium travel, that still didn't offset those earnings per share cuts. And if we take a look at business travel specifically, the growth is only projected to be 0.7%. So we're not seeing those inflows of extra premium travelers coming into the market. And we think about premium travel, Delta is kind of the one that my mind goes to. That's a tough battle they're going to have to win against them.
All right, the arguments have been made. Thanks for laying out the bull and the bear cases for United Airlines. Now we're going to turn to some option strategies to trade it. Before we dive in, it is worth noting options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Matt, let's start with you. How could a bull trade United Airlines?
Yeah, so a bullish investor can take advantage of earnings coming out in a little bit, as well as the current uptrend, by just jumping into a long call. So looking at something like the 130 strike price, you're looking at $7.75. It's a little cheaper actually today. Now the stock has pulled back a little bit, so you can get that at a lower price even now. But when I was pricing it out, $7.75, so your max loss is $775. Break even is at $137.75, so even below the highs that we were experiencing last week. And the profit potential is technically unlimited. Ideally, this option would be short-term. Earnings obviously brings in a bunch of premium volatility, so you are paying up to get that premium. I would suggest, if you are going to be someone who's looking at this kind of trade, take a look at maybe getting out of the position before earnings, so that we don't get that volatility crush. So just trying to ride the wave back up before earnings, and then when earnings happens, you won't be in that volatility crush situation. If you wanted to hold on for a longer term, you could do a spread trade, kind of reduce that volatility crush happening by just legging into a spread. So, but for me, I mean, thinking that individual investor, bullish, jump in a long call. It's pretty simple, and you minimize your risk.
Right. Straightforward strategy with the long call. What do you got for us, Jay?
All right, it's hard to deny. Let's go. We've seen the bull run. I know we've seen a few successive days of red candles, but that's why I've chosen to go the route of a spread. So it's an opportunity to make my bearish trade a little less expensive to get into to kind of offset some of the premiums. So we could potentially play a bear put spread. So buying a nearer the money put and selling something further out of the money. It does limit our profit potential, so we don't experience gains if it goes below our short strike. But it's an opportunity once again to limit that upfront expense and that risk upfront. So let's bring ourselves into the chart. So I've got the expected range kind of priced out on here. So we've got a plus or minus about $20.15 out to the August 21st expiration. So we are taking on much more time. So we're allowing ourselves more time to hopefully be right. We can see that we've already rejected kind of off that, and we can see today is certainly helping the case. We're almost touching up against the 130 long strike that we could potentially buy, and then selling the 120s to kind of take us once again to give us that downside kind of cap, and then bring in that premium to kind of offset that cost. With if we do get any plateauing from earnings, the momentum that we have on that building right now could just continue downwards. And so this is where this is a trade that I've got the risk kind of taking a note from Hiren's book here. We can get a little review for you here. Your gains are always going to be the width of your spread, but only you're making max gain if both legs finish in the money. So in this particular case, we need UAL to be below 120, so below that. So if our expected move does bring us down outside of that range, so that's in the cards if this could happen. But from a max loss perspective, that's one of the reasons why long trades can be, especially important for folks that are looking to take on less risk. The most you're going to lose is a credit, or sorry, rather the debit that you're going to pay going into the trade. And in this case, I believe it's a little more expensive now because the stock has come down. But when I did the trade, when I drew it up yesterday, it was around $3.25. So $3.25 is max loss. Width of the spread is $10 in this particular case. So $6.75 is the gain that the kind of the meat and the bone that we're leaving for ourselves if things go our way.
All right, interesting strategies both. Thanks for that, guys. And just a reminder to our viewers that these strategies and this debate were for educational purposes. It does not reflect our personal opinions about the stock. Before we move on, Matt, you're going to take a closer look at some of the tools we got here on the platform to help traders select strategies that align with their risk tolerance, the volatility, the market outlook. Yeah, for sure. So similar to kind of the conversation that Jay and I just had about, determining whether to do a spread or a single leg, there are some tools on the platform that can definitely help you do that. Looking at my chart screen here, looking at the overview, we've got an options chain here. I'll just pull up an actual full option change for you guys. So let's add it here. Go for the full one. Let's do it. Let's go for the full. All right. So here's an options chain on the SPY right now. So looking at the individual date series, you'll notice that the volatility here is going to be relatively around 14%, 13% for 1 day out. Very minimally changed from week to week. So in those kind of situations where you have a low volatility, you're not paying up as a premium for that option. If you see that volatility is pretty high, that could indicate that the premium that you're paying for the option is going to be higher than usual. So for example, earnings is coming up for a lot of stocks lately. So that volatility will pop up and you may be overpaying compared to what you would be normally paying if earnings wasn't coming up. So that's one thing where you can kind of offset that by doing a spread trade versus an individual leg trade. Whether it's buying or selling, both of those kind of dynamics are both the same. You reduce your cost by legging into a spread, but you also reduce your risk and profit potential as well. So there is some give and take there. The outlook of your stock as well is something that you want to consider. So if you think that the stock is going to be mildly bullish, then a spread trade may make sense. But if you have a very high swing potential for your trade, single leg might be the one thing you want to do because you don't want to cap your risk. You want to be, or your profit potential. Sorry, you want to be able to take that to the moon, for example. So three things to consider: outlook, risk, volatility. You can kind of plot those in terms of looking at the risk profile tool here. So I've done a couple of examples and some trades. So we've got a single leg here on August for the SPY. So you'll see that we're capped here at our maximum loss, and our profit potential just keeps on going. It's just if we extend this chart out, you'll see that it'll keep on going, it won't stop. However, if we kind of contrast that with a vertical trade, so here we go, we've got our risk is capped at an even lower price than what it was before, and we have our maximum profit capped as well. So two different kind of scenarios for the different type of traders. Ones who like to control the risk a little bit more, pay a little bit less. You can put on more trades that way, spread your capital, diversify your investments and your trading by doing that. So spread trades is the one thing you have to be careful of those. There's a lot of contracts involved, commissions. They could be harder to get in and out of due to liquidity. So you have to make sure that you're looking at all these facets when determining versus single leg versus a spread. All right, some great tools there for our audience to put to work on their own strategies. If there's a stock you'd like to see our debaters go head-to-head on, or a market topic you'd like us to explore on the show, just send us an email, td.activetraderlive@td.com. And to learn more about the TD Active Trader platform, just scan that QR code on the bottom right-hand side of your screen. It's going to take you to our website where you can open a practice account and try the platform risk-free. You're also going to find a tab that says Join a Live Masterclass this Wednesday at 2 p.m. The team is hosting an interactive session that will help you discover how to get the most of the TD Active Trader platform with a walkthrough of its most powerful tools and features. Registration is open now. It's time now for On the Radar. Before we wrap up the show, we want to get an idea of what some of the key events that investors will be focusing on for the rest of this week. Who's kicking things off? Are you kicking things off?
Yeah, I'll take the reins on this one here. So we got a relatively kind of light start to this week, but things really kind of pick up the latter half with the FOMC minutes. That's kind of the attention grabber that's going to be happening on Wednesday. Now, if markets are currently pricing in kind of a 25 basis point rate cut from the Fed over the remainder of the year, and that's not expected out of the next meeting.
Rate cut or rate hike? Where are we at?
Ooh, geez. Well, right now they're talking about a rate cut is what
now we're
I've
back
seen.
to
So,
cuts, are we?
but that's the beauty of what's coming out on Wednesday.
Just like the tech stocks flip and flop.
100%. That's it's anybody's best guess. It's not like you're watching for Alan Greenspan's briefcase like you used to back in the day. But anyway, so the minutes are coming out on Wednesday. So that's going to be everyone's going to be paying attention. So that my rate cut might be your rate hike. So it's all depending on how hawkish or dovish those notes are coming. So the really things we're listening for, how are governors, are they feeling about sticky inflation, and how are they feeling about potentially slowing economic growth? A sign that more members are leaning towards easing could boost rate cut expectations, and maybe there's more than one, or maybe towards the end, maybe a jumbo cut. And once again, all is on the table for that. But if there is more hawkish terms, look for treasury yields and the US dollar to take off as well. So those are kind of key things there. In terms of, we don't want to forget about the other events that are happening the rest of the week. We've got Thursday, we've got weekly jobless claims, and we also do have existing home sales. So these are going to be key events, fresh signals around the strength of the labor market, as well as the health of the housing sector. And we've talked about it as well many times. Next week, we really get going with earnings season as well, with U.S. banks kind of taking their typical lead at the top. So Tuesday is going to be a kind of set your TV, and we're going to watch for that. The who's who of U.S. banks: J.P. Morgan, Bank of America, Goldman, Wells Fargo, Citigroup, all reporting Tuesday before the bell. So.
All right, and we got another company on our radar too, PepsiCo. You doing PepsiCo or am I doing PepsiCo?
I've got PepsiCo here, so let's keep rolling with that. So I know we're earnings season officially, maybe starts next week, but let's not forget about
it is always snack and pop season.
That's their hope, right? And so when the chart will show you how things are interacting in real time. But let's not lose sight of the consumer staple. It's a major conglomerate, right, for PepsiCo. Certainly, we'll be watching for its own guidance going forward, but analysts use PepsiCo as part of the puzzle to kind of, piece together kind of what they're thinking about consumer demand trends are for the second half of the year. So everyone will be watching for that more than just the company itself. But here's a quick primer I want to listen for them. One will be around demand here in North America. It's been soft for several quarters. So there's definitely been some weakness in the snack and beverage, and we want to see if that in volume is improving. But investors want evidence that price cuts, promotional tactics, and are bringing customers back without sacrificing market share. And then we'll move on to kind of margin versus pricing. PepsiCo maintains they're looking to maintain their margins through more value offerings. So want to know more about that. So, and a key factor there is going to be kind of productivity gains. They're instituting, from both freight and factory, they're instituting some automation efforts, and they're really looking to be putting AI to the test in their supply chain management. So I want to hear if those are really saving any money, or is that going to be enough money saved to offset increased costs and softer pricing. All right, but from the top line perspective, the low end for earnings per share is slated to come around 219 revenue, 23.9 billion, increases of 3.5% and 5% year over year. But outlook will be more important than the results for this quarter alone. We're looking for commentary on international growth, which has actually been propping up the domestic volumes. So we want to hear some guidance there too. Let's get ourselves into the chart. So 140 has been a very key level for PepsiCo pretty much for the last year or so. We can see that we bounced off of 140 towards the start of the year and rallied up quite drastically. There's been a double top, kind of your telltale kind of reversal sign. We've seen the stock kind of bounce off there, blow through the measured move and that into kind of pretty steep kind of downward trend. This is kind of the opposite of the UAL chart we were just kind of looking at here. But what's really neat that we talked about that 140 level, the stock bounced off that 140 is now today has gapped up quite significantly. So we've actually broken out of this trend channel. So we're almost actually at the expected move on the upside of earnings, and earnings isn't until Thursday this week. So if positive news comes out, we could be looking to breach through the 155 level. On the downside, we're looking that 140 would still be in play.
All right, that is PepsiCo. What if someone's going on vacation? Wynn Resorts.
Wynn Resorts, yeah. Not a lot of fundamental that I'm looking at right now. It's mostly a technical play. Earnings is a little bit further out than what we've been looking at. Obviously, PepsiCo is coming out very soon, but Wynn Resorts has earnings coming out in August, so still some time between now and then. But the chart's really in a great spot to kind of like be able to digest a bunch of technical indicators. So if we dive into it, you'll look at this longer term chart here. We've got a downward trend channel kind of happening here. The stock really broke through that, had a bottom in April and broke out of that trend. However, it's been trading sideways. So for the last few months since April, we're creating some triple bottoms here. Hopefully this one, if it does reapproach this neckline that I've drawn, it will potentially have an opportunity to look at breaking out of that. If we look at volume profiling, there's a lot more volume in the 126, 125 range. So if it does break out of this 112 kind of neckline, there could be minimal resistance on the upward move. However, though, if we don't hold this triple bottom and we start breaking lower, we could be forming a continuance of the downward trend. And if we kind of zoom out of the chart here, there's not a lot of support below it. So if there is an opportunity for, let's say, the bears to grab the reins, you could have the stock kind of drop significantly from where it is right now. Looks like we're bouncing off of that kind of bottom today. But in the next few days leading up to this, if we don't kind of continue that upward trend towards the neckline and we break through these triple bottoms, there's not a lot of support to help the stock kind of bounce back. And who knows, earnings might not be as good as it could be. And the previous low for the year is 65.25, and there's not a lot stopping us from getting there. So pretty interesting situation for Win. Both a bull and a bear could potentially take on a trade here just to see how it plays out. So time will tell which one will grab the reins.
Okay, interesting names. PepsiCo, Wynn Resorts, FOMC minutes, lots going on. Before we say goodbye, it is time to decide who's going to argue which side next week when we debate Hilton Hotels. Jason, you're in the hot seat.
Right.
We got our coin back that you took on vacation with you last week, turned into a medallion. Of course, as always, one TD means that you landed the bull case. Many TDs on this side means the bear. Here we go. Whoa, that's not a good one. I almost threw it at you. Boom. What we got? We got the one TD, means that Jay is the bull next week for the debate. That's the show, guys. Thanks for everything. As always, investors should perform their own due diligence before engaging in trading. Thanks for watching.